First, I'm going to talk about a concept that I call the value gap. Second, I'm going to show you how we measure the value gap and how it's instrumental in everything we do, from picking stocks to building our portfolios. And then finally, I'm going to discuss a new fund that we have launched in order to help clients benefit from the opportunities that we see before us in the small cap world that both Arnold and Steve spoke about. So let's begin first by identifying and defining the value gap. Simply put, the value gap is the difference between the price of the stock and the underlying value of the business. If you recall Ben Graham's famous quote where he said, "In the short run, the market is a voting machine, but in the long run, it's a weighing machine," that's exactly what he was describing. He was describing how in the short run, market gyrations move stocks all over the place, but the underlying value of the business is what defines the price over the long run. And as value investors, that is our goal. Our goal is to capture that gap, the difference between price and value. Now, the value gap, there's three components. There's the price, there's value, and then there's time. And we're going to address all three of them. So let's start with price. This is a very generic chart of price, two stocks, stock A and stock B. So I think if we look at it, we can all agree that stock A moves up and down much more than stock B does. Now, how people perceive this up and down movement, or what is also called volatility, differs from some groups to others. The value investor looks at it and says, "Oh, look at stock A. I see great opportunity to buy low and sell high." The academic, however, looks at that and says, "That volatility, I see risk," because the academic assumes that price and value are always the same. You see, for them, for their formulaic theory, the price and value must always be equal, or the formula doesn't work, it won't balance. However, for the value investor, he understands from both experience in the marketplace and just plain common sense that they're not the same. In fact, it's the volatility that occurs in the marketplace that creates the opportunity to buy low and sell high. And this was the genius in Ben Graham's quote, because he understood that there's a lot of reasons people vote on stocks in the short run, without regard to what the underlying value is. But at the long run, it's the underlying value that always plays out and dictates the stock price eventually. So that brings us up to the next component of the value gap, and that is value. If we look at the goal of value investors, it is to value the business, compare it to the value the business and compare it to the stock price. And when that stock price differential, the difference between the price and the value, is big enough and it meets their hurdle rates, they'll buy the stock. Pretty simple. We think there's one flaw, one thing lacking in that, and that is that approach often doesn't measure how wide that value gap gets. It doesn't measure how wide it gets and how, especially at the extremes, and then how narrow it gets when the market recovers. And it was this void, along with the teachings of Ben Graham, where Arnold developed a different methodology, which we call the HMA, or the historical multiple analysis. This is the fundamental tool on how we value every company in our portfolio. So you see, Arnold developed this about 38 years ago so that we could capitalize on the value gaps when the volatility created those gaps. He understood that in order to capitalize on it, we need to address three primary issues. One, we had to be able to appraise the fundamental value of the business and separate business risk from price risk. We also had to take that valuation and apply it across economic cycles so we could see how wide the gap would get. And then we had to employ a margin of safety approach so that it instilled discipline in buying and selling companies. And from all of this, the HMA, or the historical model, was born. They don't teach it in business schools. It's unique to Century Management, and again, it's the cornerstone of what we do.